Welcome back to CohnReznick's Accounting Standards Update webcast series focused on ASU number 2014-9, Revenue from Contracts with Customers. I'm going to take us through our fourth and final part of our webcast series on the new revenue recognition standard. We will begin our discussion today with a high-level review of the first three webcasts within our overall revenue recognition series. As we discussed in the last few webcasts, the joint effort of the FASB and IASB results in aligning U.S. Generally Accepted Accounting Principles, or GAAP, and International Accounting Standards with a few minor differences. The final guidance eliminates the transaction and industry-specific revenue recognition guidance under GAAP and replaces it with a principles-based approach for determining revenue recognition. It affects all entities, public, private, and not-for-profit, that have contracts with customers. While some of this sounds pretty straightforward, it is important to recognize the fact that changes can be huge depending on the industry that your company is involved in, as all prior industry-specific guidance regarding revenue recognition is eliminated. Furthermore, the new standard significantly increases the revenue-related quantitative and qualitative disclosures required in financial reporting. The FASB's guidance affects any entity, as we said before, that either enters into contracts with customers to transfer goods or services, or enters into contracts for the transfer of non-financial assets, unless those contracts are within the scope of other very specific standards. For public organizations, the standard is scheduled to become effective for all annual reporting periods beginning after December 15, 2017, and for non-public organizations, the standard should be applied to annual reporting periods beginning after December 15, 2018. And in the year of adoptions, organizations can select from two methods of reporting, the full retrospective method or the modified retrospective method. In our past webcasts, I presented a transition timetable that CohnReznick recommends for companies beginning the transition process and highlighted that the time to get started is now. The key transition steps and their associated timing are presented here. As we discussed in Q3, organizations should have been identifying project sponsors and their change management group while also building their implementation task force. In Q4, organizations are encouraged to train and educate organizational personnel and to begin to understand their key revenue recognition streams, their accounting policies, and the various treatments of their current revenue streams. And toward the end of Q4 and into the beginning of 2017, companies should begin to select a sample of the contracts to apply the standard and do their impact assessment. In the final phase, we will discuss the conversion process, and we will discuss implementing and embedding new processes to comply on a going-forward basis. Given that the impacts of the standard extend far beyond technical accounting, the level of preparedness or lack thereof within each company can be a cause for concern, and rightly so, as most companies will see at least some level of change. While most public companies will not start applying the guidance until 2018, preparing for the change will likely require significant effort that can entail a substantial amount of time, and that is why CohnReznick has been suggesting that getting started early is the right way to approach this process. Companies will need to continue to assess their business processes, data, systems, and internal controls in order to determine whether they can capture and report the information needed to comply with the new standard. The final conversion activities. As calendar year-end companies begin to move further into fiscal 2017, they should begin commencing the conversion process. Once the conversion has been completed and the company is ready to begin reporting under the new standard by January 1, 2018, if the company is a public entity, the company should be focused on implementing and embedding new processes to comply with the standard on a go-forward basis. We'll dive a little bit more into each of these steps on the following slides. Commencing the conversion. By now, if you've been following along with the timetable described during these webcasts, much of the groundwork has been done, hopefully in Q3 and Q4 2016, as well as some sort of impact assessment in early 2017. As such, you should be ready for the heavy lifting of the conversion process itself. At this point, if it had not been determined at the start of the project, the company should determine which adoption method it will proceed with. Note, there is still a lack of clarity on which of the two methods of adoption the majority of U.S. companies are planning to take. Companies may wish to quantify the potential impacts of both adoption methods, although this is a lot more work, and weigh the pros and cons of each in order to determine which option will be best for their organization. From here, the company should map all accounting policy differences noted during the impact assessment and will begin to establish new policies and processes sufficient to address those gaps. In addition, the company should begin to address various system impacts at this time. The company should also consider a dual gap approach. By monitoring the impacts to revenue recognition, the implementation task force and other members of the implementation team will be better prepared to inform key stakeholders of the types of reporting differences the adoption of the new standard is having in real time. The results of the dual gap approach should be discussed with the company's external auditors as well as across functions within the organization. Implementing and embedding new processes to comply on a go-forward basis. As the company moves into the post-adoption phase, this is the time to implement and embed the processes that will be needed to comply with the new standard on a going-forward basis. This is the time the company should focus on institutionalizing the new compliance processes, ensuring the company's systems are capable of consistently providing the data necessary to comply with the new reporting requirements, testing new processes and controls, particularly for U.S. public companies required to comply with the Sarbanes-Oxley Act, and drafting new enhanced disclosure requirements. In effect, the embedded systems will have an impact on each of the following: people, business processes, data and systems, reporting, both internal and external, and policies. The impact on people across the organization should not be underestimated. Some of the following considerations should be included in your implementation plan to ensure that the new standard is appropriately applied on a going-forward basis. The work of the cross-functional implementation team should continue for some time after initial conversion, ensuring updated training on new revenue recognition policies, procedures, and tools, if applicable, establishing new key controls over the revenue recognition and ensuring proper segregation of duties, and possible revisions to compensation arrangements. Processes. Several processes may be directly impacted upon adoption of the new standard, including but not limited to the financial close process, financial reporting, including the disclosure processes, income taxes, contract creation, revenue allocations, compensation and/or employee commission arrangements, budgeting and forecasting. In addition, internal audit processes and SOX-related certification processes may need to be modified. In other words, there may be some new review and approval processes as well as the development of new key controls. Data. It is likely that the impact on data and systems will also be significant. In particular, companies should be prepared to design new systems or rebuild current systems to support the new revenue recognition principles. They should be prepared to ensure that contract terms and conditions and sales order processes are effectively integrated to ensure proper recording of revenues. They should determine new data elements that will allow for more effective and efficient recording of revenues for specific rules, and there is a need to allow for certain flexibility in cases where judgment may be involved. They should also establish appropriate revenue recognition rules where applicable. Connecting systems, such as customer relation management, services project management where applicable, and others. Finally, it is recommended to automate processes if possible. This would include billing, revenue recognition and revenue deferrals, if appropriate, and renewals in the case of subscription or other recurring revenue streams. Reporting. The financial reporting processes are perhaps the most important processes likely to be impacted by the adoption of the new standard. In particular, the following areas of both internal, i.e. management, and external financial reporting are likely to involve a certain level of change. For instance, updated executive level dashboards, management reports, and performance metrics may be required. In addition, the ability to provide meaningful, detailed data on revenue-related information may be needed. And finally, new disclosure requirements will occur, both quantitative and qualitative. The development of new accounting and other business policies will likely begin as soon as the transition process gets underway. Key policy considerations include the transition approach, specifically the adoption of the full retrospective versus modified retrospective approach, guidance with respect to applying judgment to the following: collectibility, multiple element arrangements, and variable compensation, establishing materiality thresholds, and streamlining contracting policies, including contract standardization, which is highly recommended, and guidance regarding side letters and/or subsequent contract modifications. So let's review our transition journey. In our previous webcast, I presented a transition timetable that Cohn-Resnick recommends for companies beginning the transition process and highlighted that the ideal time to get started was back in Q3 2016. However, if you have not started, meeting the implementation deadline is still possible, but it is no longer feasible to delay the implementation process. Unfortunately, as I stated in our very first session many months ago, there is no silver bullet to solve the implementation dilemma. The only way to know for certain how long it will take your organization to implement the new standard or how many resources will be needed to do so is to get started on the transition process now. With so much in the way of complexity involved, particularly in certain businesses, it is important to stay out in front of this process to avoid it becoming a crisis. Again, I want to thank you for your participation in all of our webcasts so far and wish you luck on your transition journey.